Time for the stress test. This time the stress test is on the bulls. The bears have had a pretty long one. In fact, the famous quote that a bear market rally can last longer than you can remain solvent was probably most true, at least for the Indian market. The first time I've seen a market actually last on the bear side that long. Almost 1.5 years into November, from March 2009 to November 2010. And that's probably why it was a little surprise. Essentially, you expect that a bear market rally would be a retracement, 61%, 78%, and then you give up somewhere that, okay, you may be wrong. But almost 99%, that's I think the first case, at least as far as the Sensex and Nifty are concerned. And therefore it's taken a couple of months to actually digest what really happened. I've tried the bullish counts only to see them falter at each stage. But the more recent events and the more recent charts, at least from the global side, have made things more and more apparent that the original view, which I still maintained on the website, the quantitative cycle view, which I've been questioning, which I wrote almost 15 months back, is still happening. The events that have played out even within India in terms of the Indian quantitative cycle, the winter coming, it's actually showing signs of playing out in terms of the events, because what I originally wrote was that inflation and would lead to higher interest rates and stall growth. Unfortunately, the rise in interest rates was so slow and so narrow last year that growth continued to happen, and the markets moved still higher, still being a retracement, but still higher to levels that really pushed you against the wall. But now that you see what has happened in the last 4 months, it's just looking like it was just a matter of time. It's unfortunate that we didn't get those hikes when you had double-digit inflation. The problem is now, when you do that under the current circumstances, you can actually stall things more sharply than you realize, especially if the global scenario turns bad. Even though you may have a lot of domestic triggers, you might actually get pushed back. And that's why I said this is going to be now the stress test for the bulls. The bears have already had theirs.
This chart quickly shows you the wave structure, the fifth wave ending in 2008 Jan, and a bear market running into March 2009 being a 5-wave decline, and the entire B wave being a complex corrective. And so you're looking at a C wave, 5-wave decline, a bear market, of which so far we've done 1, 2, 1, 2. So we have 3, 4, 3, 4, 5, that is 5 waves down or 3 impulses down and 2 corrective rallies that can head towards the 2008 lows again as the overall structure.
So what is it that I'm really seeing? If my original scenario holds, then it's a deep cut. You go back to 2008 lows. If it does not, which is what now most of the other bear market rally authors are saying, they're just expecting this to be either a correction or a retracement of the rally. We'll see, because like I said, the quantitative autumn, which is a growth phase, to extend really requires government action, which so far is still lacking. And it might be a little late because the global risks have now become fairly apparent, which I'll talk about next. In fact, I wrote about them and put out mails over the last week. Even today I've put out a couple which would clearly highlight what I'm seeing happening over the next couple of months. So those are very strong risks that we are seeing from the global side come up. And domestically, since the market's been languishing, we're really not seeing new buying happening. In fact, the last 2 weeks of volumes were so thin, neither buying neither selling. Any trigger either way could drive the markets, and so far we have still not gotten any positive triggers. So any negative triggers would actually push prices down much harder than they would otherwise when liquidity and volumes are good. So the two key negative factors which are apparent from the global side: one, what happened more recently in commodities. I think too many people wrote about a commodity bullrun that could simply go on as the dollar collapsed. The obsession with that collapse is quite apparent across authors. But the way it actually played out, and I was actually watching the trades across commodities, the big winners were crude, silver, and copper, but copper ended up being the first to top out. And then if you watch the intermarket divergences which I wrote about between copper, lead, zinc, initially they were giving divergences which looked like could be a little positive. We got that run up in lead when I wrote about it, but it didn't last. It simply led to short squeezes happening in lead, followed by aluminium being the last one, and silver right in between, which was one of the biggest gainers, squeezing itself out. The way this entire episode played, which is with a lot of intermarket divergences within the commodities space, is not typical of a bull market. It's more typical of a bear market rally distributing within, or rather a huge distribution pattern, whether we call it bull market or bear market, because you did have certain commodities raise up to new highs. In fact, like I wrote earlier today, oil's fifth wave on a multi-year basis only ending this year as a truncation. So
this chart shows you all the base metals, the lead lag effect, with copper topping first, then nickel, followed by lead, and then oil and aluminium. And essentially in all of these cases, the third wave essentially was shorter than the first wave. But when you look at this chart, the CRB, Reuters, Jeffries index, then you see that the third wave and the first were actually equal, and therefore they may have been an ABC, retracing exactly 61.8% of the entire move.
Definitely, it means that it may have, in some commodities you may have a continued bull market from the past, but the huge intermarket divergences have led to some kind of distribution happening in that segment and ending there. So I think that's one bubble that might have got itself done for now, and you really need some clear new triggers to get that one started again. So chances are that you're looking at an across-the-board commodity seller. The CRB index itself, which I mailed last week, where wave A and C are in perfect equality and retracing exactly 61.8%, is a little ominous. If that index actually holds the 310, 320 mark, it will make it look like a normal correction from where maybe commodities move up again. But the way it has happened, like I said, equal to C61% retracement, the risks are high. You would not really like to bet on a pause. You'd really like to see a pause happen before you bet on it. But the chances of this being the end of a major bubble in commodities is relatively high, and therefore you want to really see stability before you want to be a bull on the commodity space. In fact, the real opportunity might now be on the short side of the commodities. And the second risk, the second big risk, which I've been highlighting again and again in the last 2 weeks, is the one that is going to come from Europe. I think the European markets, the entire fall for 2008-9 was a clear 5-wave. I think those markets were the clearest in terms of counting 5-wave on the monthly down. And that meant that the rally post 2009 should have been a bear market rally for most of Europe. It's very true there. You haven't seen the kind of retracement India got in Europe. In fact, most markets have varied divergences in terms of their retracement. The FTSE doing 78.6, some of the weaker ones like Spain and Greece doing 50 to 61%, and Belgium, which I mailed out today, doing only 38.2%. Greece already having reached back its 2008 lows, and Spain and Belgium actually hinting that they're just about completing some kind of a E-wave in a wedgish or triangular pattern at the end of the retracement rally, from where the next leg down could start anytime now. So the risks are extremely grave from Europe, and US might just be the last one to join the overall equity market distribution that has been happening over the last 1.5 years. And there too we've seen, even between world markets, I think we can see the same kind of divergence, where some markets have reached near double top, some of them are retracements, some of them are weak retracements, and many of them count like wave A for 2008-9 and wave B. After that, there are only few which are new bull markets, like probably Sri Lanka or Mongolia, and those are probably exceptions to the rule. But most of the others count clearly as an A down and a B up.
Here's a quick look at the Spain chart, and most European markets look like this: a clear 5-wave decline, a multi-year head and shoulders, and a wave B occurring on the right shoulder being a retracement, either 50%, 38% or 61%, and wave C about to start anytime now.
In India's case, I tried thinking whether it was something different, but the fact is, unlike most of the double tops of 1992 to 94 or 2000 to 2004, this time around the second top did not go beyond the first one. In all those earlier cases, the second top always went higher than the first one, and therefore it could have been an impulse move, even though there was a double top correction after that. And that is why I guess a lot of people are still thinking that this double top too will see the Sensex only do a retracement. But the fact is that we did not cross the 2008 highs. In fact, the mid-cap index retraces, the 500 retraces less than the Sensex, the mid-cap retracing only 78%. That itself showing some kind of divergence and weakness in the breadth of the market, and therefore confirming that yes, this is not a bull rally but was a bear market rally, only it lasted longer than you would have liked it to. And now the next leg down has started since November. A perfect confirmation, since I was trying to mark the current move since the March lows as a wave 1 as a final attempt. The final confirmation would be 5345 on the Nifty, 5345. The March low actually brings that would be a confirmation that it's definitely not an impulse. But most momentum indicators have started. The weekly momentum confirmed the sell this week, both on the rupee and the Sensex, and that I think is your first indication that the counts are the bear market counts and not the bull market counts. I will actually update those and show the alternate counts, or I may say the original counts that I was following again on Indiacharts.wmv on Monday. Therefore, because of these risks, and because I think the chances are that we are really seeing a lot of pressure build into the domestic markets, and we're seeing 5-wave declines occurring in some sectors like the auto sector and technology, weakening on momentum. Those two I had actually been writing about as having ended something in the last couple of months. Now I guess more and more sectors would confirm, especially banking, which has been one of the key performers of this move, and therefore it was not clear what the entire 2008-9 rally counted like for banks, because some of them really went beyond 1.618 times the previous moves, and those were significant and made you think whether you should look for impulse or a new bull market situation for banking. So I think that will remain one sector that we'd really like to see how it unfolds. But the risks are extremely grave. You're not seeing any buying interest, you're not seeing volumes, you're seeing weak momentum, and you're seeing now these two global risks which are actually more apparent than the domestic ones which are going to play out. And the key trigger level for a sharp sell-off would be around the 5,000 Nifty level, which would be the neckline of a head and shoulders multi-month distribution pattern, and we are on the right shoulder of that. Volumes declining throughout the 1.5 to 2 year period on the Nifty and the Sensex, again signs of bear market rally and distribution. So I think we're in for a serious test of bullish views that are still hanging out there. In the next, maybe very soon, maybe within days, weeks, the global scenario would probably start playing out, I think, extremely soon now, because the signals are very close, the patterns are so far close to completion and so extended that I think the events should start playing out in the immediate future. So you really need to be careful on the positions that you really take, and what it might actually hold out is probably a lot of opportunities on the sell side or the short side, and you'd need to really call your triggers if you're still long. That's all for me on this update. I hope it clarifies what I've been writing about over the last week and helps you take those decisions. Thanks and bye.